Today, I want to talk about why Citadel is about to take the fall or be the fall guy for the financial collapse. At the moment, the Fed has two choices. They'll either save Citadel and their massive toxic short positions and watch more and more banks fail, or they allow Citadel to collapse along with their toxic positions and rescue the banking system. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Whelp tweeted saying, if you see this Mayo boy, then know that you did it to yourself. This extract says the DTCC is staring down the barrel of a profitable earnings call for GameStop last night, trying to figure out how they can get out from under this nightmare. They call Kenny or Ken Griffin and say, look, print as many synthetics as you need to keep this mess from exploding. We'll have your back. Except the DTCC is not planning to have Ken's back. They're going to tell Switzerland to buy out their nuclear swaps and let Kenny keep the price down, in essence handing him the Archegos bag. Effectively, Credit Suisse or UBS is going to close out of their toxic shorts, while Ken Griffin creates more toxic shorts to try and push the price down, thereby effectively assuming Credit Suisse's toxic short position. And he said the DTCC are going to let Ken Griffin be the fall guy and then blame Citadel for everything, effectively just like they did with Bernie Madoff. And he said if this week ends with greater than 216 million shares traded in GameStop or potentially 2 billion shares traded in AMC, I will be convinced that within 35 days we'll see Ken thrown under the bus completely. Now you may be saying, Tom, why exactly does the Fed have to choose between the major banks and Ken Griffin? Why can't they save both, or why don't they just let both fail? Obviously, Ken Griffin, along with the major banks, is orchestrating these giant toxic short positions, but on the other hand, we have all of these major and minor banks collapsing. The easiest way to stop the banking collapse is effectively to transfer any of the toxic positions from these major banks into Citadel and allow Citadel to collapse. As Sven tweeted, you can see from this chart that it's not just a few small banks and that it's not an isolated banking problem. This chart shows the primary credit loans on liquidity and credit facilities at the Fed. You can see in 2008, the maximum use of this facility was over $110 billion. In 2020, the facility only used around $50 billion, therefore showing that in 2020 there was less desperation than in 2008. But right now, already we've seen this facility being utilised up to $150 billion just in the last few days, more than it was in 2020 and more than it was back in 2008. On top of this, Finance Lancelot just tweeted saying the Fed has started a new facility for repo operations this week as well. And he said this is the final warning before a crash. He said it's now a self-fulfilling prophecy. He said this confirms that interbank lending has stopped and we're on the verge of a crash. He said the Fed knows, the banks know, and now you know as well. So this is a facility for other repurchase agreements, not overnight reverse repos, not overnight repos, not just regular repos, but other repurchase agreements. We can see this facility was used fairly minimally in 2008, up to around $120 billion. Obviously, in 2020, this skyrocketed to around $450 billion. Right now, we can see the use of this facility is only just getting started, but obviously it's going to compound and get worse as the days and weeks go by. And Finance Lancelot is saying this facility is effectively a facility that is used when interbank lending is shutting down. Now, the reason why these facilities are being used and the reason why the banking crisis is happening is because it's not just isolated to 2 or 3 banks like Silicon Valley Bank and Signature Bank, or maybe Credit Suisse as well. Also guys, if you haven't already, be sure to join me over on Moon with the sponsor of today's video by signing up using the link in the description below. You can currently get up to a whopping 17 free shares, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very easy to use. They've got tons of technical indicators and advanced charting tools. With Moomoo, you've also got entirely free 24/7 customer support, and you can also trade around the clock with their full extended trading hours. Because you may have just seen this morning that Deutsche Bank shares also slumped by more than 10% and its credit default swaps have surged amid wider concerns about the banking sector. So not only do we have Silicon Valley Bank, Signature Bank, Silvergate Bank, First Republic and Credit Suisse, but we've now also got Deutsche Bank as well. There's a chart here that shows the Deutsche Bank credit default swaps are absolutely blowing out. now wider than they were on March 15th, and wider than they were in 2020, and wider than they were in the fourth quarter of 2022. I think these credit default swaps are also higher for Deutsche Bank than they were back in 2008 as well. Right now, the Deutsche Bank 5-year credit default swaps are currently sitting at 525 points. Remember that Credit Suisse's only a couple weeks ago were only sitting at 300 points. Deutsche's credit default swaps are very quickly rising, and as a note, Credit Suisse actually shut down when their credit default swaps tipped over 1,000 points. It may say, Tom, 525 points isn't really that close to 1,000 points, but considering the rise that these credit default swaps have seen over the last few days, from just over 200 points to 525, these could soon explode very, very soon. But on top of that, it's not just Silicon Valley Bank, Signature Bank, Silvergate Bank, First Republic, Credit Suisse and Deutsche. It's also Charles Schwab as well that seems to be struggling. This is the Charles Schwab 5-year credit default swaps that right now are higher than they were back in 2020 and higher than they were in the fourth quarter of 2022 as well. And as Morton GME tweeted, he said, let's take a look at something almost nobody is talking about, and that is Charles Schwab. He said Charles Schwab is your friendly neighborhood broker, but somehow wrongfully or rightfully, they've got caught up in the regional banking route. Now, he said either that's effectively a complete mistake or somebody knows something and they've got a ton of exposure to toxic derivatives. Charles Schwab is down nearly 35% in the last month, actually down more than Deutsche Bank is. Obviously, remember that Charles Schwab owns Interactive Brokers, or IBKR, which is chairmaned by Thomas Petterfy, who has been looking incredibly uncomfortable. Therefore, it's likely Charles Schwab or IBKR is also on the wrong side of GameStop and AMC as well, and is likely being left hung out to dry. And on top of that, it's not just Silicon Valley, Signature, Silvergate, First Republic, Credit Suisse, Deutsche and Charles Schwab, it's also UBS as well. Because UBS's 5-year credit default swaps on subordinated debt has just risen an additional 24 basis points to 325 points. So you can see that right now it's literally the entire banking system that is either potentially collapsing or is just very, very unnerved, and that banking runs are occurring on pretty much all major bank and minor bank and even trading platforms and brokers as well. Many are saying the Fed has absolutely zero control on what is currently going on, and therefore really they need to shift the risk from the entire banking sector onto one specific fund or person or market maker or major bank and just let it collapse. And that is why, as Welp tweeted, he said the DTCC is likely to try and shift everything into the hands of Citadel and just let them fall. And Colin also tweeted saying shout out to Bigums, who, for as long as I can remember, has been talking about banks collapsing. Now, obviously, back in late 2021, I did say when the stock market crashes, it would indeed cause the AMC squeeze. I have to admit that back in late 2021, I couldn't imagine in my wildest dreams that it would have led to a banking collapse that ended up causing the stock market crash and the squeeze. However, as times have changed over the last 2 years, especially over, say, the last few weeks or the last month, it seems that a banking crisis or a banking collapse is becoming more and more realistic. I do imagine that if this crisis gets much worse, it will lead to a stock market collapse that will also lead to the AMC and GameStop squeeze. This is effectively exactly what we've been saying over the last 2 years, and it's finally coming to fruition. And to show just how much the shorts are panicking right now, check out this chart tweeted by Jackie. So this is the total GameStop short volume, or the total number of shorted shares for GameStop over the last 5 days cumulatively, or the last 5 days running. We can see from this chart in the last 5 days, GameStop has experienced 20 million shorted shares. You can see where the commas lie, it's 20,067,622 shares. Now, this is obviously an absolute rocket, and the last time we saw this many shorted shares was in very early 2021, aka January of 2021, and in very late 2020, aka December of 2020, just before the big run-up. And over the last 2 years, the total number of shorted shares for GameStop has laid somewhere between 200,000 shares and 800,000 shares, and also between 400,000 shares and around 3.4 million shares every 5 days. This is a level of shorting that is effectively unmatched, only last seen in early 2021, just before and just during the big run-up. I think this really goes to show exactly what position the shorts are in right now. They're trying everything they possibly can to hold GameStop and AMC down, shorting 20 million shares in a 5-day period. They're trying their hardest not to let these toxic derivatives blow up while the entire banking system is collapsing around them. So I think the Fed really has one decision to make, which is who exactly should take on these toxic derivatives. They need to find someone because they need to avoid the banking system collapsing, but who can it be? And obviously the clear answer is it's Citadel Securities. Citadel Securities and Ken Griffin are perfectly replicating Bernie Madoff and his fund, generating massive record-breaking profits in 2022, a year where pretty much every single hedge fund lost money. I think what they'll do is blame it on Citadel and Ken Griffin and say, look guys, he just got past us. He did generate record-breaking profits in 2022, but for some reason we didn't think it was suspicious and we didn't investigate further. The same thing happened with Bernie Madoff. He was generating these record profits and the fraud completely got past us. We don't know how it happened, but at least we've caught him now and he's probably going to go to jail for a long time. Ken Griffin is effectively the perfect excuse or the perfect fall guy, as he's effectively replicating Bernie Madoff on a 1-for-1 scale, doing and acting pretty much exactly like Bernie Madoff did all those years ago. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.